Now we can turn to the U.S. consumer a bit more. What are some of the impacts to them that we continue to see, and some of the data points that have come out from the U.S. and what does that mean for the next couple of not only just weeks, but over the next few months. And before we get into it, we'd like to please remind you, like, share, subscribe. Your support, greatly appreciated. It helps us so much on a lot of levels. So again, please continue to share and watch our videos. So here is this is something that I'm going to start using more as I found this index through an article I found, and it's something that's free. It's the Port of Los Angeles Signal. This is as of January 13th. It's updated on a weekly basis. So this is just looking at the issues that are coming into the Los Angeles port, because we continue to see TEUs coming in, volumes of containers coming in, which is growing, just again, coming back to wholesale inventories. How do we get stuff into the U.S. to backfill some of the supply chains? But we're seeing a huge disconnect in terms of time from port into inventory and into the market, which is increasing the cost of trucking. As we'll talk about in our EIA show, when we look at truck demand index, which is going to remain elevated, it's because there's such a sluggishness getting onto from the boat to the port, from the port onto a truck into the market. And then on the other side, you need not only to take containers off the boats, but then you need to refill them with either empty containers and or backfill back to the location that they came from. And then we're just seeing those problems because we're having trouble getting the containers off the boats. But then on the other side, whether it be Korea, Japan, China, they have a shortage of empty containers, again, coming to where this disconnect continues to rise, and we continue to see pressure on the supply chain in general. And this is just a great segment in terms of just showing just how many container ships locations. This is as of January 13th. I know people have posted pictures of what's happening in California as they're driving along the water, and you just see lines of boats just sitting off the coast. And the American shipper, which is the company that had links back to this, interviewed Akip Laut, which is executive director of the Marine Exchange of Southern California. And he reported that as of midday Wednesday, 91 ships were in port, 46 at berth, and 45 at anchor. Of those, there were 56 container ships, 24 at berth, 32 at anchor. Between Wednesday and Saturday, this previous one, 19 more container ships will arrive, with the same number due to depart. So trying to maintain that balance. It takes 2 to 3 weeks for a container to cross the ocean from China to California. But the problem is, so that's the time frame. So we need to clear out to try to get stuff back to open up and free up some of the space. And just the inherent slowdowns based on COVID, because California has had their own restrictions. You have limitations on the amount of employees. You have an increase in COVID cases, so less employees show up or can show up or have to go into quarantine. These are things that are continuing to limit the amount of efficiency and that we're seeing on our side, which is, again, being married with the issues on the other side. So again, that 2 to 3 weeks for containers to cross the ocean is only extending because they're spending more time at each port. So yes, you're in the water moving for 2 to 3 weeks, but you could be sitting at port for 10, 12, 14 days on either side, just extending those issues, which again comes down to price, because now you have to pay more to get those containers as container prices continue to explode higher, which we'll show in a later segment. And when we look at, again, equipment leasing, so the Russell 3000 Index commercial vehicle equipment leasing subsector continues to grind higher. J.B. Hunt, blew out their trucking numbers just because the amount of revenue you're going to generate on a trucking side, just given the shortfall. And this is just showing the amount of commercial vehicle equipment that's going to continue to see some of those benefits, as we see not only it on a shipping side, trucking side, but also trying to get into infrastructure and some of these other benefits, which has outperformed the S&P 500, and it's unlikely to see that change, at least in the near term. But when we look at, okay, well, the focus is we need to refill the supply chain, but what about the consumer? Because right now the U.S. retail sales fell 0.7% in December after previous months were revised lower. So this is also going to help refill inventory as people buy less or do less with their money. You're going to see, again, less inventory being moved through the system. So that will help refill inventory, but it's also pointing to the weakness in the consumer. We saw that big spike from April into May as people got their money and they started to spend more, and people delayed their purchasing, and then they got that check and they went out and purchased. Well, we think that there's going to be a similar bump, obviously, when the new checks show up, but it just won't be, it'll be muted in the sense where we know December was weak, holiday spending, and it was weak when we look at where was it in 17, where was it in 18, where is it in 19. So you even had weaker year-over-year comps, and we're just not seeing that same type of growth because, again, the consumer continues to be under pressure. But we do have job vacancies on the factory side coming back to, well, we're seeing some movement where some people are looking to hire. And again, there's, as we talked about the PMI side, especially on the manufacturing, employment is still in growth phase. It's at 52.6, so it's still within that margin of error, but still on an expansionary side. It's still driving forward. So again, these are some benefits which will again pull some of these job vacancies back into the market. It's just at what rate? Because we've seen a lot of wage cuts or people accepting lower wages just to get a job. So even though we're seeing vacancies, at what rate will that salary be or that hourly rate be in order to incentivize and get some of these people back into the working world? And now when we look at the percentage of companies making decisions in response, this is one that looks at the data a little bit differently because we've talked about how work from home is becoming more and more important and just a cost-saving metric for the company itself. So when we look at less than 20,000, told at least some employees not to work, continued paying employees not working, the no telework before or during pandemic. So the lower the wage, the less likely you are to be able to work from home. But as we pivot into that 40 plus category, you can see that there's an increase in telework. The increase in telework available to employees is that orange color. And you're seeing that that's just increasing over the period of time. And when we talk about these groupings, both the company and the employee want to maintain a certain flexible work schedule, which is something that I think it has to be considered when we look at how is this going to change consumption forever, or at least over the next couple of months and years as people get used to working these blended schedules. And this is something that is going to be a much bigger component, I think, on demand cycles and how people consume online versus in stores, and how does that change the retail consumption patterns. And then when we look at on more of a global level, on firms thus far have been more likely to reduce hours or wages than fire workers. Again, coming to that underemployment level where people have less money to do things. So this is looking just globally on granted leave, reduced hours, reduced wages, laid off workers. On a percentage level, granted leave and reduced hours, you're talking about almost 75%. 75% or so of these workers were granted the ability of reducing hours and then reduced wages and reduced hours. We're talking about 33% reduced hours, reduced wages about 25%. So you're talking about over 50% of the people that were in this survey have seen their cut in wages. Companies are saying we're doing it to survive, but again, these people now have less money to do things with. And that comes to how are we going to see that react within the government, within the economy, and how is the government going to respond with stimulus, as we've seen emerging markets, developed markets continue to try to stimulate. But when we look at this widening spread, again, coming back to where the widening spreads between the 2 and 10 year, again, this is the yield. So as we see this pain happening on the consumer side, well, your hedging and volatility remains light, as very little hedging is happening right now because people are like, well, you're doing all the stimulus. We're seeing inflation coming into pricing. We're not seeing wage increases. So there's going to be this concern. And I think you're starting to see that price in, where the biggest spread in more than 3 years, when we look at the 2 and 10 year, again, giving confidence to people that this yield curve is going to continue to steepen. And by steepening, it's going to increase cost of borrowing as we roll as we roll debt. Yellen has talked about introducing a 50-year bond. Is there an appetite for it? Likely. At what cost is going to be a bigger issue. Again, these are things that we have to look at when we're considering where is inflation expectations and where is borrowing rates going to go. And even though the Fed is keeping rates where they are they going to try to do some sort of yield control? Europe has already started that. The ECB has already started that. Are we going to start to see something similar? Because Operation Twist was a nightmare that didn't work. Will they try something a bit more aggressive and try to play with duration and some of those duration fears? Now, when we look at U.S. equity inflows, have been very strong. So let's put it that way. I don't need a chart to show you that. You can pull up the S&P 500, the NASDAQ to see that equity inflows have been strong. The net long-term portfolio inflows, net foreign purchases of U.S. equities have been massive over that time period. But again, as that pressure remains on the government, on the government side, corporate side, are we going to see people looking to essentially sell some of the benefits that they've had on the international side, lock in some gains, try to bring some dollars home, help solidify their balance sheets? These are things to consider, because the net foreign purchases is the one that I think is going to slow the most, especially as people maybe try to reweight or readjust their balance sheets. Currently, that is not happening. as if you bought Netflix on the close and then waited for their numbers and then sold it, 20 minutes later, you would have made about 13%. So again, these are things to look at when we're considering just how frothy the U.S. market really is. But and I said it in the pregame show with David. Are we in a bubble? Absolutely. But who doesn't know that? And the question is going to be, when does it pop? Is it a hard landing, soft landing? Those are the things that we're trying to eke out with. And where is the data? Where are some correlations? Where are things that we can look at of like, oh, this is going to be a problem? Not yet, but again, as this starts to build, as this becomes a bigger issue, and the dollar weakness has been a big supporter of some of where things are. If the dollar rallies, will that take some of the air out of the recent moves? And again, when we look at recent moves, well, retail sales, broad decline. Where did we see those declines? And this comes to the consumer overall. So we saw that reduction, but gasoline stations saw an increase overall in terms of clothing, motor vehicle. Again, people are buying cars, miscellaneous, health, building materials. It's furniture, retail, sport, general merchandise, food and beverage, core retail. The core retail, I think, is the biggest one to look at, because core retail is where we're getting kind of that nuts and bolts, as we talked about last week, of where are the bigger issues starting to form. And then electronics and non-retail. This is something that is going to continue to shift down even through January. Even when we start to see these checks disseminate throughout the system, it's going to be tough to see these retail sales pop over the next few months, especially when we look at consumer prices. And again, this is the biggest conundrum when people talk about there's no inflation. Okay, well, let's look at major appliances. Major appliances year over year is up 17%. Used cars and trucks up 10%. Again, people moved from the urban to suburban and bought a car. They bought new cars, they bought old cars. That's where we continue to see, but again, they bought them. We haven't seen anyone driving all that much. So again, we're going to have to look at where are some of these movements. But care of invalids and elderly, household cleaning supplies. Again, who isn't buying bleach right now? Food at home, tools, all items. So again, these things that people are buying are continuing to move higher. Prescription drugs have gone down. Insurance has gone down. Why? People driving less. If you're driving less, you don't need as much coverage. There's less risk for the insurance company. Hotels and motels, nobody's going anywhere. Men's suits, you're working from home. I'm wearing this. This isn't a suit. gasoline, airline fares. So the things that are weighing down on inflation are things people aren't buying, so they're not benefiting from that. And then the things that they are buying are getting pressured higher. Again, this is why that bifurcation within the pain, as wages are cut, as hours are cut, as wages come down, prices are going up. Again, this is going to limit the amount that people can do. But again, looking at driving, because people bought cars, online shopping continues to be a huge component of just consumption in general. So the US dollar, obviously, moving where it is, but with the share percent, this is the one that matters the most for us in terms of it dipped into January, but we're going to see that flat line. It's going to continue to maintain the market share where we're not coming back to where we were at the beginning of the year. People that move from that urban to suburban setting are going to continue to shop online. They're going to continue to purchase online. Retail sales are rolling over. But again, even though retail sales are coming down, the percentage of online purchasing remains strong, and we'll continue to see an increase in adoption, especially as the retail side, the bricks and mortar, push their online, push the e-commerce. And when you think about, the curbside, people are buying more curbside. Again, these are things that people are doing to adjust their consumer behavior and their patterns. But when we think about, okay, well, what is happening on the Empire Manufacturing? Empire Manufacturing ticked down. Some of the leading indicators from the New York Fed moved lower, and they're actually negative again. So when we look at manufacturing, so the headline down to 3.5 versus 6 estimate and 4.9% in the prior month. New orders up along with work hours, but employment fell. Again, this is kind of that bifurcation of the number of employees started to roll over just as business conditions continued to get worse. This is something that we think is going to converge where they're still going to be above zero, but we think employment, as we talked about with hours and the employment in general, will still be expansionary, but we're just going to see that slowdown in just total activity, where is the industrial production by market group? So you're seeing consumer goods. People are buying more goods because they obviously have to, just because you need to survive in general, and people are home more, so they're consuming more. But business equipment, construction supplies, materials have seen a recovery, but the pace has been very slow. And just based on what we're seeing with construction supplies on the commercial side, residential, gangbusters, not saying it isn't. The commercial side remains very weak. Business equipment, again, is going to continue to weaken as people stay home. You start to see that blended schedule. Corporations shrink their footprint, which again is going to pull some of that demand down and is going to push more of it into the retail residential side. So while consumer goods have recovered back to where we were pre-COVID, the others haven't, and it's going to be very difficult to see how they can, just given some of the headwinds that we face over the next few months. And then where have we seen the growth? So sector share of the economy and employment. So the nominal GDP, where is it generated by? The government side continues to be very large. The government on the employment side remains elevated. But when we think about the S&P 500, what was the biggest driver? So in terms of GDP, you had 6% in 3Q. 2% of employment in November was in technology. But yet the returns in the S&P 500, 38% was in tech, and it's going to only go higher as more people are buying the NASDAQ. And again, this is where, even though the economy, this is why the economy is weak, struggling, but the returns that we continue to see coming into the actual equity prices, and this is where, again, they were not seeing the same type of movements. Where can some of these tech startups start hiring people? Absolutely. Like there is growth to be from the equity price. We've seen secondaries, we've seen new issues. So clearly there's going to be that movement, but we need to see technology employing more people, because as we'll talk about with the EIA, and we start going through some of Biden's policies as we turn to energy, there's going to be pressure on the energy side, industrial materials side, And as we know, consumer staples, consumer discretionary, that remains under pressure as bricks and mortar. Retail bankruptcies continue to accelerate, as we talked about in the previous segment. Those are things that we're going to have to look at as we try to see how can we get to the health of the economy. And then when we look at percent of total unemployed by reason, you can see that job losses on temporary layoff, job losses not on temporary layoff, that continues to increase. Again, that's why we're seeing that focus on Biden stimulus driving in some of that extension of the unemployment rate, unemployment payments to cover that increasing growth that we've maintained really from April as those go from temporary to permanent. They're going to need that support to try to get back on their feet or try to find some jobs as we try to bring or attract new jobs for people. But where is the working age? And again, this ties back to pensions because where is the working age? So year over year, U.S. working age, 20 to 64 population growth, the history and projection. So we've had a big trough in terms of the individuals working within that age gap, and it's really not expected to adjust until the end of this decade, which again comes to why why we're so concerned about this decade in particular, because again, pension funds are going to struggle because there's less people paying in, as we're not getting anywhere back to that average because we're at a shrinking level. So do we get some COVID babies? Do we get some people that are bored at home trying to get some of this boom back on the expansion side on the population? Perhaps, we saw that. We've started to see that coming through overall, but we need to see some of this pickup on the working individuals to try to not only pay into some of these pension funds that continue to struggle, but also we're seeing this weird backdrop of, well, automation is bad, but yet we have less people to work, but yet we still have an extended amount of people in unemployment. There's going to be a lot of unknowns that are going to have to be figured out or looked at and evaluated at this point to see how do we kind of close some of this gap and get people back into the office, or not just offices, into jobs and into seats in general. And this is looking at household post-tax cash. Like obviously we had our increase in April, and then we're going to have an increase in Jan, just as more dissemination. But again, that drops off quickly. And that drop off is going to extend, and we're not going to see that slow grind down like we saw in 2020, providing some of that uplift. Again, coming back to how is the economy going to look in Q1 and Q2 as these initial claims. Again, this big increase, which we'll get an update tomorrow, when we called it here, the numbers were weak. They're going to continue to be weak, and we have some makeup from states that didn't report because of holidays, and then people delayed reporting just because they were with their families. So this is something that's going to remain elevated. Not to say it's going to be another huge jump, but it's going to just stay in that 1.2 to 1.5 million growth side, with the initial jobless claims coming. The expectation was 789, came in at 965. Continuing claims were supposed to be at 5 million, came in at 5.271. Again, that acceleration is going to be there, which is leading to the consumer sentiment. Consumer sentiment continues to be weak as people are not liking their current situation. Expectations are coming lower. This is why people won't be spending. So you give them a check, it doesn't mean they're going to turn around and spend this time, as we were seeing this prolonged drawdown, this problem with just how are we going to incentivize the consumer, which is, again, looking at that consumer sentiment. Consumer sentiment continues to weaken. As we look at, the expectation was 79.5, came in at 79.2. Again, looking at the charts as what it was the survey and what actually happened, and this is why we continue to be concerned about where are we going to level off. And again, this is looking at some of those numbers as we start to compare them and what the trend looks like. So the U.S. Empire manufacturing slowing, just as you see adjusted retail sales on the down 0.7. The core group, the one that's the most important, down 1.9%. It's down 1.9%, and the retail sales control group was supposed to be up 0.1%. So it was a huge miss by about 2%. And this is in December when people are supposed to be buying for holidays, which is why we continue to point to where the problems are arising, and consumer travel ambitions are taking a step backwards. This is looking at Google. People are searching less as we go into January, we're starting to see people saying, well, this vaccine rollout's not going all that great. We're seeing some increase in cases. Let's just hold off on some of the spending, which is leading to consumer comfort index going lower. People are concerned about what their comfort looks like. They're seeing this slowdown. Again, we're back to where we were coming out of the initial lockdowns as we see this prolonged problem that is remaining in the market. And again, U.S. renters and homeowners have seen cost increases ease, but ease by how much? Because now rent on primary residency year-over-year change has come down. It's now 2%. We've shown how it's increased on prices. Owner equivalent rent has come lower, but that's starting to pivot. So this is looking backwards. So this is looking at, okay, well, where have things been on a year-over-year change? Let's look forward now. Well, medium co-op condo prices year-over-year percent, adjusted 5-year quarters going forward is up to 10%. Which, even though we saw this CPI blended primary rate rent, you can see how they track each other pretty well. This is going to start to shift higher, and it's going to pull that number up, which again is going to lead to more inflation, more pain overall as we look into, how is the consumer looking? Their wages are weakening. Obviously they're slowing down on spending, which is going to be difficult to generate that consumer in that GDP number. And the government just won't be enough to make that up as we see private investment slowing, a big expansion of the trade deficit, which again is just going to remain given all the bottlenecks and issues that we're seeing, which is just going to lead to a very weak and or weakening recovery or just a stagnant recovery as we look at the U.S. economy going through not just Q1, but into Q2 and potentially into Q3.